Rajat Sharma too on the show with us. Rajat, hi, afternoon. Just wanted to understand whether or not you've been a buyer in the recent correction in the market or waiting for the dust to settle down just yet.
No, broadly waiting for the dust to settle down, but I have added stocks which I spoke about last time, which was ONGC and Coal India, and the reason for that was these were tactical calls, and I still believe you can add these stocks to your portfolio. The reason being, if this war continues, oil prices could keep going higher and higher. So oil exploration companies will do well. In fact, energy is a theme for the last 6-8 months. I've believed whether it's coal, thermal, petroleum, that theme will do really well world over. So, this is a tactical call. If you're sitting on a profit of 20-30%, you can hold on to it. I think it would probably keep rallying from here. So, ONGC, Coal India, these stocks still have a lot more upside left. But again, this is not from a fundamental perspective. There's no harm holding these stocks. Fundamentally, also, they're very good companies. They have very high dividend yields. But my call, just to clarify, has been very tactical. Last time I was on your show, and last 2-3 times I've been recommending these stocks. So other than that, as I've said for about 6-8 months, there's very little reason to buy these markets. And right now, a lot of people are talking about the dip that the market has fallen, and the Ukraine-Russia conflict is primarily the reason why the market has fallen. My fear is, or my sense is that if there is any stability in that region, there could be a sudden bounce back in the market, but that does not change the fact that these markets had to fall. And as they say, markets always find a reason to fall. This time it came in way of a conflict. The bigger worries that remain is interest rates, which have to go up. There's a lot of liquidity still there in the world. We don't know when the war will settle. We don't know what happens to crude prices. We don't know if we're completely out of COVID. But when I look at the positives or why you should buy stocks at this time, I find very little reason to, other than the fact that I'm in the business of financial advisory, and recommending stocks brings me livelihood. But other than that, there's very little reason to fundamentally buy stocks for a long term.
Yeah, it sure is. I was just looking at PVR, for instance, while yesterday it didn't react to the buzz that, they're in advanced merger talks with Sinopolis and that the deal is likely to transpire by March end. But today you're seeing some of these reopened trades actually hold out quite smartly. Would you be a buyer in any of the hotel, hospitality, multiplex names?
I do believe in this reopening theme. I do believe that these companies will perform much better than what they have done in the past 2 years, because even if there is a wave going forward, by all accounts, it would either be milder or it's more likely to be ignored by people unless it's really, really deadly. Having said that, the reason why I won't buy these stocks is because these stocks have already recovered in the hope of this reopening trade the last full year. So, in a market which is extremely fragile, a lot of these stocks are trading at, I think PVR at 1590 or 1600 rupees. Indigo itself, some close to its all-time highs. I would buy these stocks at the prices at which they are. If they were available cheaper, where they should be, given what's happened to these stocks for the last 2 years, I would definitely buy these. But if there is a crackdown in the market, and again, I don't believe falling from 18,600 to 16,000 is a big deal. I'm expecting a very sharp fall given everything that's happening around us. So I think despite the fact that these companies, from a business perspective and balance sheet perspective, will probably do very well or well compared to the last 2 years, but stock prices are a very different reality. I won't own them at these valuations.